what follows the deflationary crash is a massive increase in the money supply. The governments of the world will have to inflate their way out of what they perceive to be a potential depression. And if you own gold and silver, when that happens, you're going to do great, because when they're inflating away the currencies of the world, precious metals will just take off. To think about right now, because the world is going to get chaotic. Even if you take the geopolitics out of it, we're still piling up too much debt, and that's going to lead to a financial crisis at some point, which in turn leads to a currencies reset. These things were all coming before the Iran war, and they'll be even closer after we start having to pay for the Iran war. And that puts a lot of things at risk, including possibly your job, but also your ability to pay for things to get fixed when they break. So if you have the time and if you have the interest, this is a good time of life to start learning how to do things, to get handier. If there's something you don't know how to do, like certain things on your car, or electrical things, or welding, or whatever. Those are things that you'll have to pay up for when you need it. And if you're able to do those things yourself, then you're a lot more self-sufficient and resilient. And self-sufficiency and resilience are two things that you ought to be pursuing pretty actively.
This isn't just another short-term move in gold. It's the same macro structure that appeared in 2001, again in 2008, and again in 2020, a slow loss of confidence in paper stability, followed by a fast repricing of hard assets. The bond market usually sees it first, then currencies react, then precious metals move in a way that feels sudden, violent, and shocking to anyone watching too late. What matters now is not the daily candle. It's the widening gap between sovereign debt expansion, sticky inflation pressure, and declining real purchasing power across developed economies.
Do you anticipate, what are we already seeing, and what do you anticipate being a likely trend that would be good to be ahead of?
Well, this is going to be the best earnings season in the history of the mining industry, at least in terms of gold and silver, because the price of those things have been rising. And, they were not rising, but still pretty high during the first quarter of the year. And that means that these gold and silver miners are getting more for each ounce that they sell. And they're generating a lot of free cash flow. Newmont, the biggest gold miner and one of the biggest silver miners, just reported yesterday. And they had free cash flow of $3 billion, which in the mining business is a lot of money to play with, And what they're doing right now is they're buying back their stock and they're raising their dividend, which is a really nice thing for them to do for shareholders. And at some point in the future, though, when you're generating that kind of free cash flow, it eventually burns a hole in your pocket if you're the CEO of a mining company and you start going out and making big acquisitions. In Newmont's case, their production is stagnant, and that's a tough thing to justify when you go before your shareholders. Why aren't you growing? You've got all this money. So at some point, they're going to start buying up the smaller miners. And if you own those smaller mining stocks, that's a good thing. That's generally a good thing, because they'll have to pay a premium. When they're inflating away the currencies of the world, precious metals will just take off. And I think that a few market shorts, a little bit more gold and silver, and we're probably okay to get through this.
One thing that's perhaps a not obvious potentiality is regarding AI is the not in my backyard syndrome. We just saw a news story last week in our neck of the woods where they're building a massive data center, rallies against it, and the community is getting organized to say, we don't want this here. We don't want it taking all the power, all the water, and all the space, and all that. That's something I didn't see coming. Any thoughts from you on pushback, not just from potential job loss from professionals, but actual not in my backyard pushback from people not wanting data centers and other aspects of AI to come at their lives, in addition to loss of privacy and all kinds of other things, concerns you have?
Well, yeah, that's happening across the country now, because people are figuring out that AI data centers aren't good for them necessarily. They're not like a microchip plant coming in where they're going to hire 2,000 skilled workers right away. AI data centers come in, they don't hire that many new people, but they do push up electricity rates. So you might end up seeing malinvestment out there that's all going to crash at once, and that's going to pull the stock market down, which in turn will affect the economy and give us recession or depression. Just AI. it kind of guarantees some really wild financial times going forward, no matter how it turns out. So yeah, I think a deflationary crash followed by an inflationary crack-up boom is, a completely viable scenario. So Michael is right. He's a smart guy, and we should be listening to him.
So for an ordinary mom and pop facing those eventualities, what kinds of specific moves financially would be appropriate in your mind to weather such a sequence where you had a deflationary recession or depression of equities and bonds, followed by a stagflationary period of protracted, long, slow slug out of that?
On a deflationary phase, the first part of this, let's say AI starts laying off a lot of people and the economy starts to tank. You don't want to be massively long the stock market when something like that hits. So if you've got some profits in stocks, this might not be a bad time to take some of those profits and then either just keep them in cash. They're as prepared as they can be for this, the global effects of the latest Middle East war. And, if you're not prepared, if you're just coming to this cold with a bunch of government bond funds and other kinds of financial assets, then maybe it's time to accelerate the shift out of those things and into real assets, just in case this turns out to be the one Middle East war. I mean, we screw them all up, but this is the one that actually has dramatic global consequences.
Most individuals don't necessarily self-manage most of their nest egg. They may have delegated that to a retirement plan or to a pension or to a fund manager or some index funds and that sort of thing, or retail financial planner that says just do a 60-40 portfolio and ride the ups and downs, so you'll come out ahead in the end. Thoughts from you for people for who they've delegated most of their financial management to those, because a lot of those other people aren't necessarily doing what you just said. Those people who are the stewards of most moms and pops' retirements.
Well, actually, you just pointed out one of the reasons why the stock market is still acting like it's business as usual, because for them it is, because so many of the contribution.
This is where historical precedent becomes important. During every major monetary transition cycle, capital initially rotates into liquidity, then into safety, then into scarcity. Gold tends to lead that sequence, while silver and mining equities lag before accelerating later. The same pattern appeared during the late 1970s inflation cycle, the post-dot-com easing cycle, and the aftermath of the global financial crisis. Different headlines. Same liquidity mechanics. Markets move slowly for years, then all at once. And once institutional positioning changes, price discovery becomes extremely difficult to contain. This isn't a retail story. Central banks have been accumulating physical gold reserves at levels not seen in decades, while sovereign debt continues climbing towards structurally unstable levels. Historically, that combination has never produced long-term currency strength. It has produced volatility, repricing, and capital flight into scarce assets. The critical mistake is focusing on whether gold is temporarily overextended after a $3.800 move, while ignoring why capital is moving there in the first place. The real risk isn't volatility in precious metals. It's being on the sidelines when confidence in fiat stability starts breaking faster than policymakers can respond.